Hello and welcome to the Genuine Learning blog. My name is Melissa Galasso and I'm excited to be with you today to talk about a very recently issued exposure draft. It is coming this time from FASB. It's the Codification Improvements to Hedge Accounting. Now, hedge accounting has been in the news a lot lately. One, it's one of the standards that it's about to be delayed. So this is in the suite of items that are going to get the extra extension for private companies, but also in some of the application areas here. So the goal here is really a codification improvement. It's not a wholesale change to how we do hedging, but it is here to help us make sure the COD is understandable, eliminate some inconsistencies, and provide some clarifications on how to apply the new ASU 2017-12. So as I mentioned, this is due to ASU 2017-12, which is the updated hedge guidance. People really like the updated guidance. It's simpler. It helps allow you to do things like hedge the risk of a particular component without looking at the entire underlying. And so there's a lot of really cool things in that standard. So we're really excited to have it. But as with anything, when you're in the middle of going through the implementation, you might find a couple of little snafus, which is exactly what happened. So this was issued November 12th. Comments are due January 13th. So again, very targeted improvements to hedge accounting, trying to improve the financial reporting, and the goal of the entire standard was to better portray the economic results of their risk management. So if someone is hedging, there's a reason for it. What are they trying to mitigate? That's really what they want to make sure keeps consistent. And so they are trying to simplify, right? So sometimes some of the application material caused a little bit of question, and so we're trying to address that. So there are a few things that are addressed in here. The first one is changes in hedged risk in a cash flow hedge. So there's a couple of different things here. It clarifies that the forecasted transaction and the hedge transaction are distinct. And so that's a term that we're familiar with coming from the RevRec standard. But in this scenario, they're really trying to give us some additional criteria on what would be applied to designate the hedged risk, and then what would be to identify the forecasted transactions when they occur, right? So they're trying to provide that additional clarity so that we know what criteria we're applying. They also are giving additional clarity on how designating a best estimate of the hedge risk interacts with the guidance to A, assess effectiveness, and then B, determine whether the forecasted transaction hedged in a group share the risk exposure for which they are being hedged. So two areas that they're really addressing within that forecasted transaction area. Another thing they're focusing on is the contractually specified component. So as I mentioned earlier, one of the things is in the past, you'd have to hedge the entire inventory. You couldn't do a component of it. So in here, if you have a non-financial forecasted transaction, right, they are now allowing you to use a contractually specified component, so long as it's contractually specified. And so how do you know if something's contractually specified? Well, it should be in the documentation. So they're going to provide additional clarity on the nature of the documentation that evidenced a contractually specified component. They're giving us information on how do you evidence a contractually specified component being obtained, in terms of the variability in that specified component. And then also clarity on how an entity, or whether really an entity, must apply the normal purchases and normal sales scope exception to forecasted transactions to be eligible for the contractually specified component risk hedging. So again, just trying to address really niche hedging issues. The other area that they focused on is foreign currency denominated debt instruments as hedging instruments and the hedged item. So this is called a dual hedge, and I'm going to read you the definition. So a dual hedge is one in which a foreign currency denominated debt instrument is designated as the hedging instrument in a hedge of a net investment in foreign entity, and the hedged item in a fair value hedge of the interest rate risk designated under the hedging subtopic. So you have the net investment hedge and you have a fair value interest rate hedge, right? So dual hedge. Well, when you have that, there's a mismatch related to that. So this is going to eliminate the recognition and presentation guidance related to the dual hedge. Again, you have two different sets of accounting telling you to do two different things, same item. And then also an entity should exclude the foreign currency denominated debt instruments fair value basis adjustment from the net investment hedge effectiveness assessment. So they provide us a little bit of guidance here. The other area is really terminology. They use the same term, but had different meanings for it, and that obviously is difficult for us to ascertain. So it replaces the term prepayable with the term early settlement feature for the purposes of applying the shortcut method to be explicit about what the intent was and to make sure that people understood what the underlying term was intended to mean. So again, not wholesale changing, just providing a little bit more clarity, especially in that guidance. All right, so if you have an interest in hedging, you do a lot of hedges or your clients do a lot of hedges, this is a good opportunity. Again, you have until January, so you can take a little bit of time and think about it, but this would be a great opportunity to provide FASB with feedback about a standard that impacts lots of different types of entities. All right, so thank you guys so much for joining me on the Genuine Learning blog, and I hope to see you on a future blog in the near future. Have a great day, guys. Bye-bye.